Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilat, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, today we're talking about some market data, okay? So, the first half of August was pretty good, then it kind of faded at the end. In September, jury's still out, right? But one thing that we've been talking about almost all year is international stocks and how we see so many people in their 401k and people that are bringing their investments to us for us to give them our opinion on and to take their accounts. We're seeing that they are terribly underweight international, right? Some people have no international, some people have a couple of percent, but really it's been the leader this year. And all of our strategists, pretty much all of them, really are bullish on international.
Yeah, international was, underperformed for so long that people just began to ignore it completely. And they found themselves, in a year like this, not having any exposure when really it would have been helpful.
That's right. So take a look at this chart, right? This goes back to 2007. And you can see that the international markets outside of the U.S., right? This does not include the U.S., have really been struggling. And now we're finally pushing above those 2007 levels and breaking out to new highs. So this is from Twitter. The chart question says, does this look like the end of the move for foreign or the start? And, I think the implication here is that it's just the start. Of course, we don't know, right? But and this is education only, right? This is not a recommendation. But this chart, from a technical analysis point of view, it looks very bullish because it's pushing above the old highs, and it's called a breakout. This is a breakout pattern, and oftentimes that is the beginning of a new move.
Yeah, it's rare that you would see something break out and then quickly revert back below. But,
that would be called a false breakout,
yeah.
right? which does happen.
Like you said, we don't know, but there's reasons to be optimistic about international markets. And this is a year where we've been rewarded for being diversified and keeping some of our assets in those international positions.
Exactly. So why would international be outperforming? Well, there's maybe several reasons, but one of the things that I always think about here is the fact that the U.S. market since 2007 has just run away from the rest of the world, and the PE ratio, the price to earnings ratio on the United States market, the S&P 500, is extremely high. It's not as high as it was like in March of 2000, but it's well above average. And so that doesn't mean that it's going to crash, but it is extended, and it can stay extended for years. But it does provide an opportunity if we're a value investor, if we're looking for a growth at a reasonable price. Europe, Australia, the Far East, Japan, right? All of these areas, maybe emerging markets, all of these areas, they have trailed the U.S. dramatically, and so their PE ratios are much lower. They're more like average when we look historically, and so that is appealing to some people. So they're taking money from the U.S. and looking overseas.
Yep, I think that's a great point. In addition to the dollar has weakened some, and that weakened dollar has helped the international companies as well.
Yeah. So Jim, when the dollar goes down, the assets overseas are worth more dollars because the dollar's worth less. And on that point, in August, the Fed had the Jackson Hole meeting, and what happened there?
They talked about interest rates and feeling like we may actually be at a point where they can finally start cutting.
Correct. So if the Fed cuts, now the interest rates on your deposits go down 0.25%. Guess what? It means the dollar's even less attractive, and so that would support dollar weakness. So if that continues to be the theme, that's another positive for international. Now, this is all just speculation. This is just an educational podcast. There's no recommendations here. But if the Fed cuts, it could continue that trend for international.
Yeah, it's also, is viewed as favorable for small caps.
Yes.
Right. So we saw one of the biggest movers on that day were small caps. So again, not pointing it out because I think you need to rush in and buy small caps, but the things that we're talking about point to the reasons why we want to have a diversified portfolio.
So August 22nd, this chart here was the Jackson Hole meeting, and Chairman Powell indicated that he kind of opened the door for rate cuts. The next meeting is September 17th, so we'd be looking for a quarter cut on September 17th. But here's the interesting thing. So on August 22nd, we had a 90-90 day. And so 90% of the NYSE volume was higher, and 90% of all the stocks were higher. Mm-hmm. So that might seem like a technicality, but just because the Dow is up or the S&P is up doesn't mean that every stock is up.
For sure.
Right? Like if tech is up, maybe the defensive names are down, right? Mm-hmm. So it's very rare to have everything up all at the same time. Mm-hmm. It's very bullish. It doesn't happen very often at all. So this is since 1980. It's only happened 11 times. Interestingly, twice this year now, right? Mm-hmm. April 9th when the tariff tantrum ended, mm-hmm. and Jackson Hole, August 22nd. But here's the takeaway, okay? Even though the S&P is extended right now as far as the PE goes, and that is well above average, okay, mm-hmm. as we talked about, this statistic, it's still worth mentioning because 10 out of 11 times, if we look out 1 year after this 90-90 day, 10 of 11 times the market's been higher, and on average it's been up, 23.2%. Okay? Well, that's pretty wild, right? Mm-hmm. That's well above average when it comes to the S&P returns. And so I think this kind of stuff, it's a little bit gimmicky, but I like it. I like it a lot.
For sure. But like you said, it's viewed as a really bullish sign. So, easy to look at that and be optimistic.
But there's always a but, right? Yeah. We want to remind you, right? It doesn't just go straight up. It's not like we can say, oh, look, there was a 90-90 day. You don't have to worry about anything. It's going to be up 23%. Forget it. Right. That's not the case. That's not what we're saying. We're just providing you historical examples because volatility is still going to be there.
Yeah.
So, I've always thought that there are a little less than 10% correction per year, but this stat is showing 1.1. So maybe now that includes this year's number, right? And so anyway, I came into January 1 this year telling people and preaching and saying, what are you going to do when the market goes down 10%? Because it probably will.
Right.
And it did. Okay, it did.
For sure. Yeah, and what this chart we're showing says is that on average, at least once per year, a little bit more than once per year, on average, you will see a 10% correction. So that doesn't mean everything's changed and all of a sudden we shouldn't be in the market. It's just normal volatility.
It is, and it often is a good buying opportunity. Not every time, okay? But so this year, in late March, we were down about 10%. And then it rebounded a little bit, and then it had the big drop into early April. If you would have bought at the end of March on the 10% drop, you still would have felt a lot of pain after that. But as we stand today here in September, you would have been very happy that you did it. Last year, in August of 2024, we had like a 9.9% drawdown. It was just, for all intents and purposes, a correction, but it technically wasn't. Would have been a great buying opportunity because it snapped back even within the month of August. You were back. So I like to tell people, if you have cash that you want to invest, if you want to put money to work, you might be looking at the market today thinking, well, I don't want to put it to work on an all-time high. I get that, right? Probably you'll be okay if you do. But I understand that mindset. And so here's, you probably have 7 chances to buy when it's down 3%.
Yeah. Right, each year, yeah.
And probably one time each year for a correction. And in 25, did we have a bear market? Well, again, technically no.
Yeah.
But from the February high to the April low, intraday, it was down 21%. So, great buying opportunity. Okay. The key here with the bear market is if it goes down 20%, it's a great buy if there's not a recession. If there is a recession, then it usually keeps going down. Now in 22, technically it was not a recession, but we did have 2 negative quarters of GDP back to back. And that's the textbook definition. But I think they're playing games with the data. Like all these jobs numbers, like it's kind of crazy. But that was down 27% in 22. So just because it's down 20 doesn't mean that you're going to pick the bottom.
That's a good point. Yeah. But I think the biggest takeaway is just to realize that if we do see some pullbacks, whether it's a mild 3% or a more severe 20%, to know that historically these happen. That doesn't mean everything's changed if we see a pullback. It just means this is normal volatility.
Correct. So I think it's time to ask ourselves, what are we going to do when we have the next mild correction or bear market? How are we going to respond? We should always be thinking about that, right? Because right now we're just riding that wave, okay? But the wave comes into shore, and then you got to have a plan for what happens next. If you would like us to take a look at your portfolio or your financial plan, if you're looking for a second opinion, reach out to us at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilat. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.